Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets. Kansas City wheat. There is a lot going on here within a fairly narrow piece of action, not in market price movement, but in a narrow piece of market angle of attack. To explain, the recent past keen patterns have been the late March to late June diamond pattern type, with the extension of its lower uptrend and the larger big inverted roof pattern, sometimes called a half diamond pattern. In early August, the market punched down through the base of the inverted roof pattern and headed lower ever since. So where does that leave us now? In early October, prices saw some hesitation, even a small recovery, over the 50% Fibonacci resistance of the big 2011 to 2019 move at 691, but failed to stabilize over the bigger 50% absolute Fibonacci line at 697, and once again headed lower. 3 weeks ago, I highlighted a new feature I saw here. Looking at the action since August, I saw a possible descending expanding wedge pattern, currently 592 to 687, which is highlighted in dark blue on my daily chart. This is not the best example of such a pattern, but as I said last week, and I quote, it does hold merit, and I would look to this pattern for some immediate idea of the move downwards, end of quote. Well, it does hold merit, but I have also seen the development of two new patterns, one of which involves the descending expanding wedge pattern. So, if we utilize the lower trend line, currently at 592, which is highlighted in blue, of the descending wedge pattern, and then the newly drawn upper trend line in dark green, currently at 651, we have a bear channel within the original descending expanding wedge pattern. Then again, if we look purely at the new upper and lower dark green trend lines, currently 619 to 651, we have a descending wedge pattern, once again within the original descending expanding wedge pattern. I hope I've been able to explain what my thoughts are, and also the three main patterns, currently bearish patterns, that are driving this market. Please feel free to replay this part. So what do we have in the way below that could obstruct further declines here? Well, there is only one level nearby that might support the market, apart from the trend lines, of course. And that is the 38.2% Fibonacci line of the big 2011 to 2019 move at 618. Though I have my doubts about it. Beyond that, there is the July 2021 low at 578, and perhaps the more formidable March 2021 low at 559. Minneapolis wheat. Compared to Chicago wheat and Kansas City wheat, Minneapolis wheat had been somewhat easier to read in recent times with respect to what was going on and what the opportunities might be. This is no longer necessarily true, but it still has its moments. In late February, and especially at the start of April, so that just within my daily chart, you can just see it just about, the market constructed a large bear channel that morphed into what we see highlighted in dark blue on my daily chart. A descending expanding wedge pattern, which is 606 currently to 808. This actually originated from December last year, but really became evident from February this year. The upper trend line has been escorted and reinforced, sort of, by the declining medium moving average, currently at 797, which, when combined together, helped cap the market back in very early April, then mid-April, mid-May, and mid to late June. However, in mid-July, the attempts higher resulted in a clear break above the upper trend line, and also the important declining long moving average, currently at 824. Now, prices climbed rapidly up to the 50% Fibonacci line, a significant August 2020 to May 2022 move at 955, where the rally petered out and turned back down. It is this turn back down that has captured my attention, as the market had, since late July till mid-September, formed a descending scallop pattern. Not only that, but since mid-September, we have seen the market form the crucial ski bump of this descending scallop pattern, and since the start of October, start on its journey lower to potential targets below for such a pattern. Thus, a primary target X for such a pattern would be in the 708 zone, with a secondary harder to reach target X1 in the 689 zone. In early to mid-October, the market made a valiant attempt to turn back up, but the May low at 769 capped the rise and turned prices back down into a band of supports, starting at the August 2017 high at 754, then at 744, then the important June 2021 low at 737, and that is the gateway to a congestion band between 737 to 724. All these were tested, but they held. Eventually, though, there was some serious testing of this support. Now, before I go any further, I wish to clarify the word held. You see, the implication of held is that prices rebounded. Well, they didn't. Prices got bogged down in a wider band between the August 2017 high overhead at 754, ably now reinforced by the slowly declining and highlighted in green on my daily chart, short medium moving average currently at 757, and congestion, stratified congestion below that stretches down to 724. So the opportunity to move lower is still there should prices drop below this 737 to 724 band. Then the next congestion is at target X at 708, and it would then highlight a newer pattern, one that I spotted 4 weeks ago, and that is the nascent late August to date bear channel, which is highlighted in bright red on my daily chart, currently 685 to 772. It is interesting to note how we have a smaller bear pattern nestled within a larger bear pattern, much like a Russian doll. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.